The broadcast is now starting. All attendees are in listen-only mode.
Good morning, and thank you for joining us for today's webinar. We'll be getting started shortly, but I wanted to take a quick minute to go over the format of today's webinar. All phones have been placed on mute for this webinar. If you have any questions throughout, please use the Questions tab in the menu, and we will address questions at the end as time permits. We will also be recording this session, and the recording will be sent out tomorrow morning. If you are attending this webinar for CPE credit, you will need to complete all 3 polling questions presented during the webinar, along with completing the follow-up survey that will be emailed out tomorrow morning. Again, thank you for joining us. At this point, I would like to introduce today's presenters. As the industry leader of our educational institutions group, Marcus Harwood has extensive experience working with colleges, universities, and independent schools. In serving educational institutions, he interacts with school business managers, audit committees, and boards of trustees. He is a frequent speaker on topics of interest to colleges and universities and has most recently made presentations on the topics of corporate governance, the Uniform Prudent Management of Institutional Funds Act, and the impact of Sarbanes-Oxley legislation on nonprofit organizations. Marcus is responsible for audit planning, fieldwork, and supervising staff. In addition to overseeing audit engagements, he performs acquisition-related due diligence procedures. His extensive experience providing services to a wide range of industries, including education, insurance, healthcare, and nonprofit. As a manager in our accounting and auditing group, Matt Coit provides audit services, supervises fieldwork, and oversees staff accountants during the engagements. Matt has experience providing services to clients in a wide range of industries with a focus on municipalities and utility companies, as well as professional services firms. He works closely with a number of the niche areas within the professional services group, including law firms and in financial management. Other industries served include manufacturers, distributors, and retailers. As a tax manager in Bloom's state and local tax group, Chris Buno has over 13 years of experience serving clients in a wide variety of industries, including aerospace, manufacturing, retail, and construction. In this role, Chris focuses on state and local tax advisory services, such as nexus studies, taxability analysis and determinations, sales sourcing reviews, voluntary disclosures, and planning opportunity reviews. I'll now hand it over to Marcus Harwood to begin today's presentation.
Thanks, Jared. We'll get started. What I would just add to what Jared said by way of introduction is a reminder that we're sharing the views of ours as individuals. We are not standard setters. We don't represent the FASB. We don't represent your audit firms. But we are sharing our perspective. Hopefully we can provide some useful food for thought. I think you have the ability to submit questions. If you do so, we may answer them as time permits during the presentation. If not, we will be back in touch with you to respond to any questions that we received. Also, for CPE purposes, there will be some polling questions. They are just questions that we've created that are based on some of the materials we'll be covering. It's not a test. We're not looking and scanning individually to see who answered the questions how. But if you're interested in CPE for attending the seminar or the webinar, you must respond to the polling questions. So the topics that we're going to cover today are a few accounting standards updates, revenue from contracts with customers, leases, recognition and measurement of financial assets and liabilities. We'll also talk a bit about LIBOR and some changes with LIBOR that are on the horizon. And finally, we'll talk about the impact of recent tax legislation, and finally some cash flows. If you've participated in these webinars in the past, you'll probably recognize most of the accounting issues on here. We have presented them in the past when they were more recently issued standards updates. The reason that we're revisiting them at this point in time is because they are here. With the exception of leases, all of the standards updates that we'll be reviewing today are effective and implementable for calendar year 12/31/19. So we thought it was a useful primer. With respect to leases, although for non-public companies we still have a bit of time, and Matt will be reviewing the timeline, the change is potentially very impactful, and the point is that we recommend that you make use of that time to perform the analysis and assess the impact on your organization. So jumping right into ASU 2014-09, revenue from contracts with customers. Again, I hope this isn't new information to you. It is a conversation that I hope you've had internally and perhaps with your auditors. We did modify this presentation a bit from last time, and specifically what I did, quite frankly, is we had talked about implementation project plans and timelines that involved establishing a steering committee, performing some preliminary analyses, checking in with your auditors and whatnot. Quite frankly, that's no longer relevant information. It's here. That project timeline now is, if you have not performed the analysis and documented your conclusions and had conversations with your auditors, the implementation plan is do it because it's here. And what I would suggest is that even if your conclusion or preliminary conclusion is the implementation of 2014-09 will not have a significant impact on the timing of your revenue recognition, it is still a worthwhile exercise to document how you arrived at that conclusion using the 5-step methodology that the standard requires. And so with that in mind, we will do a quick recap of the 5-step process. So keeping in mind that the objective here was to create one model for revenue recognition that would be adhered to by any financial statement issuer, as opposed to the current state situation where revenue recognition and the methodologies for revenue recognition are largely dependent on what industry you're in, whether be it software, construction, retail. There are different methodologies that you may be using going forward. Every organization, regardless of industry, will follow this 5-step model. It was intended as a simplification, convergence with international standards. When you look at the standard itself, along with subsequently issued clarifying guidance, it's over 700 pages of literature that explain this simplification. So there's a lot of details to it. And again, if your preliminary conclusion is, I don't think this impacts me, I guess I would just urge caution. There's a lot of wrinkles, a lot of details, and a lot of ways that this may impact you that you hadn't been considering. So again, thinking through the 5 steps methodically to ensure that you can document that conclusion, I think is time well spent. So the core of the principle is that you'll recognize revenue to depict the transfer of promised goods or services to the customer in an amount that reflects the consideration that you expect. That sounds fairly straightforward. In order to determine the appropriate way to recognize that revenue, you will follow a 5-step process, and you will be implementing for calendar year ends 12/31/19 and thereafter for non-public companies. So we are here, and I want to share some thoughts with respect to transition options as well. There are 2 ways that you can do this, and which way makes the most sense for your organization is dependent on the users of the statements as well as the availability of the information that you would need for either of these 2 options. Option number 1 is a full retrospective restatement, and essentially if you're presenting comparative financial statements for 2018 and 19, this involves going back to the beginning of fiscal year 2018 and recasting all contracts for both periods presented in accordance with the new standards. So you will be comparing this as fully comparative statements if you go with option number 1, and the impact of adoption would be shown as a cumulative effect of change in accounting principle at the beginning of the earliest period presented, which in a full retrospective would be effective 1/1/2018. Whereas option 2 doesn't require you to go back as far in time. What you would do is apply 2014-09 to fiscal year 2019. You would not restate anything from 2018, and the cumulative effect of adopting the principle would be shown at the beginning of 2019. So pros and cons. The benefit of option 1 is that you've got complete comparability between the 2 periods that are presented. The con is that it requires you to do more analysis of older material. So to the extent you've got a high volume of transactions and complex implementation issues, and going back further in time is going to be cumbersome. That's the con of option number one. Option two, in theory, is more straightforward in the sense that you've got a lower volume of contracts that you'll be reviewing because it's only 2019. They're more current. To the extent that you expect a significant impact from the adoption of this standard, your statements will be less comparative on the face, and so that's the argument against option two. There's not necessarily a right or wrong. It's a judgment call that you need to make. I would note that although in theory option two, the cumulative effect for just 2019 is a bit less work just based on lower volume, there is a required disclosure. You would have to show all financial statement line items and captions as they would have been under the existing revenue recognition standard. So whereas the face of the statements will reflect the new standard, which is called 606, you'll have a disclosure saying what the balances would have been under the existing standard so that a reader can understand how 2018 results compare to 2019 results. So in a sense, you're reporting under two methodologies if you go with option two. So bear that in mind. Any industry is going to be impacted. Just as a general rule of thumb, the more deliverables that are embedded within a contract, the longer period of time that you take to deliver your services, and the number of different kinds of contracts that you have, all are indicators of increasing complexity with respect to implementation of this new standard. But essentially, if you're generating revenue, this standard applies to you. So the 5 steps are identifying the contract with the customer, look to identify the performance obligations within the contract, determine the transaction price, allocate it to the various performance obligations, and then determine when to recognize that revenue. And we'll talk about briefly each of those 5 steps here. So the first poll question we have.
So the first poll question is now live. What is the current state of your revenue recognition implementation? Again, if you are attending this webinar for CPE credit, you will need to answer all 3 polling questions, and this is the first of the 3. We'll give about another 20 or 30 seconds here as people continue to get their votes in. About another 5 seconds here, and we will be good to go. Thank you, everyone who participated.
All right, so a quick walk through the 5 steps, and again, this is 5 or 6 slides that represent 700 pages of literature. We will not do it justice in the time that we have, but the first step is to identify the contract itself. When each party has rights, we can identify the payment terms. There is commercial substance, and it's probable that you're going to collect the consideration. You've got a contract. It can be written, it can be verbal. And it's not governed by the terms. It's not governed by the form of the document itself. You may have multiple contracts that are negotiated contemporaneously and are interrelated that you would consider one single contract for rev rec purposes, and conversely you could have multiple elements that would be considered separate contracts if they're not interrelated and dependent on one another. So there are some issues with contract identification. You must have enforceable rights as well. If you don't meet the criteria above, you've got to hold off on recognizing any revenue until there's no remaining obligations and any amounts that you've received are non-refundable. That's a change from existing GAAP where you may represent revenue in some cases to the extent that cash has been received in certain situations when there is no contract in place. At this point, you would have to, under 606, you'd have to defer revenue until you meet the criteria for having a contract in place. Step 2, this is more complex than it may sound. You've really got to identify the performance obligations within a contract and determine which of those have standalone value to the customer. So a typical example might be if you've got a software product or a cloud-based service, you're going to install that on your customer's IT system. You're then going to support it through a license period, and perhaps there's also customer support and other obligations throughout the license term. You've got to determine which one of those can the customer benefit on its own or with other resources that are readily available. To the extent that that's possible, each one of those would be a separate performance obligation. If you don't meet that criteria, they would be combined and considered a single performance obligation. And there are nuances to that decision making. Once you've determined the performance obligations, you've got to look at the total transaction price, and that may be fixed. Where it gets more complex for RevRec purposes is when there's variable consideration, and variable consideration could take the form of volume discounts, incentives, or penalties that are built into the contract, as well as refunds, rebates, credits, and price concessions. Anytime there's variable consideration, you're in a position where you've got to make an estimate of total consideration, and there are limits on those estimates. It must be probable that those estimates will in fact be earned and not subject to reversal in a future period. So sounds fairly straightforward. How much do we expect to collect? But to the extent that there's variables and estimates that you've got to make, there's an awful lot of nuances that you'll need to consider as you develop those estimates. Step 4 is allocate that total transaction price to the performance obligations. So remember, if we've identified multiple performance obligations, we then need to allocate that total. To the extent that dollars are allocated to those performance obligations within the contract itself, that may or may not be the final answer for accounting purposes. You've got to think about the relative standalone fair value the relative standalone selling price of each of those performance obligation. That becomes the basis for the allocation. So if the contract front-end loads or back-end loads dollar amounts and terms for cash flow purposes, that may not be reflective of the pattern that you'll recognize the revenue for RevRec purposes. Finally, step 5 is recognize the revenue when or as the performance obligations are satisfied. And the key point here is you're either going to be recognizing revenue over time as services are delivered, or at a point in time, which may be upfront upon delivery or upon completion of the services. The criteria for point in time is here. The entity, we have a right to payment, the customer has legal title, the entity's transferred physical possession, risks and rewards of ownership have been transferred, and the customer has accepted the asset. If we don't meet those criteria, we're going to be overtime, and the criteria, in order to recognize revenue over time, we must meet one of these 3 criteria. One of the areas that you'd want to focus on is the 3rd bullet point here. The performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So we've got specialized equipment that we're producing. If the contract with our existing customer goes south, we can't turn around and sell this widget to somebody else. And furthermore, we are entitled to compensation in the event that we cancel the contract midway through. We're entitled to performance or payment for performance that's completed to date. Absent that clause in the termination clause in the contract, you wouldn't meet this criteria. Then there's a number of new disclosures. Even if you don't think this impacts the debits and credits in your financial statements, there will be new disclosures that explain to users of the statements how you generate revenue. It's got to be disaggregated based on the nature of different services that you may be providing, and balance sheet accounts will be rolled forward from opening to closing, and to the extent that there's estimates, you will be disclosing those as well, along with the nature of warranties and related obligations and returns and that sort of thing. And as I said earlier, if you adopt the the modified retrospective method, where it's only being applied to 2019, you will also have to disclose what 2019 would have looked like under the extant standards. So I would say that, again, make sure that you think through the 5-step model, document your preliminary conclusions, have the discussion with your auditors, make sure that everybody's on the same page, and then assess the impact and the level of effort as you get into this year's audit. Again, it's here, it can't be deferred any longer. So we'll switch now to a discussion of the lease accounting standards.
Thank you, Marcus. This next area is covering ASU number 2016-02 for leases. This is a topic we've been touching on for a while due to the expected impact, but as implementation's right around the corner, we wanted to revisit that and make sure it's fresh in everybody's minds today. So ASU 2016-02, we're topic 842. This was issued back in February of 2016. By way of background, this has been a continuous push by the accounting world, the SEC and FASB, to ensure that all contingencies and commitments are properly represented in the financial statements, as well as to improve clarity and the quality of those financials. And this guidance is really just a step in that direction. As far as standards go, though, this one is incredibly impactful. What it's essentially doing is bringing any operating leases that are currently not recorded on the balance sheet onto the books, along with capital leases. So it's going to all be recorded on the balance sheet, regardless of capital or operating. From a public company standpoint alone, and this has already gone through adoption for those folks, but it's estimated to have placed about $1.2 trillion in new assets and new liabilities on balance sheets. So certainly not something small that we're talking about here. Private companies, this implementation is right around the corner. Fortunately, FASB delayed the implementation by 1 year. So all entities that present GAAP basis financial statements, this will be for years ending 12/31/2021. That being said, and we're going to be going through the details here, making this transition isn't going to be a small chore, so we certainly aren't encouraging people to kick the can down the road. This should definitely be fresh in everybody's mind, and some steps that should be taken this year. So from a transition standpoint, the transition method is considered to be a modified retrospective approach, which is kind of a retrospective light, so to speak. Essentially, at the point in time of implementation, any of the leases that are on the books, those will be recorded as of the new guidance as of that balance sheet date. So you're not going back to any leases that had end prior to adoption. That being said, any of the leases that at least have any period remaining during the period that you're adopting, those will have to be brought onto the books using the new guidance. So the reason that we want to be talking about this now is any of you folks that are presenting comparative financial statements, that means you essentially will have to have this information for the year end of 12/31/2020, not just for 2021. And so the time to start accumulating that information is now, even though the implementation date got kicked down the road by 1 year. And we'll go into details about that implementation shortly. So quick refresher on the current accounting before we get into what actually changed here. So a capital lease has at least one of 4 criteria. It has a bargain purchase option at the end of the lease, asset title transfers to the lessee at the end of the lease, useful life of approximately 75% or more of the lease life, or present value of those minimum lease payments is greater than 90% of the cost of the asset if it was to be purchased. As you know, if it's meeting one of those criteria right now, it's recorded in fixed assets, disclosed separately, and the lease liability is presented. And again, that's just capital leases. Operating leases, on the other hand, under current accounting, are basically just disclosed in the footnotes. Disclosures include length of contract, the type of equipment, payment structure, timing, things of that nature. Any of that expense is recorded as rent expense. You do record in the disclosures future minimum lease payments over the next 5 years and then in the aggregate thereafter. But it's essentially all disclosure based. And so the general concern was there just wasn't the same transparency that they had with capital leases when they're looking at the operating lease side. And so that's what they were looking to address with this standard. So the new guidance, ASU 2016-02, this is going to change pretty dramatically, and it's especially for operating leases, which under the new guidance, as I mentioned, those are going to be brought onto the balance sheet, and I'll be going through the details of that shortly. And the main thing to keep in mind here is this is going to apply to many items that are commonly showing up in lease agreements, things like property, real estate, land, equipment, essentially any contract where control of an identified asset is being transferred for consideration. One important thing to note, the last bullet here, things that it does not apply to, intangibles, inventory, assets under construction, service contracts. I've received a lot of questions from clients on service contracts, whether or not this standard applies to those. It does not. There's other guidance that identifies what should be followed for those items. So important thing to keep in mind there. As far as industries that we've seen that are highly impacted, certainly as you'd imagine, it'll be any of the ones that actually have a lot of leasing activity like the ones we've listed here. But I would caution you from thinking that this is an all-inclusive list. I'd say most of my clients, both within these industries and outside of them, are impacted in one way or another. So, please don't assume that these are just the only ones. This is just what we've seen as the most heavily impacted thus far in our practice from reviewing our clients. So before we get into the nitty-gritty here, just one more poll question.
So this is the second of the 3 CPE polling questions, and it is, what is the current state of your lease standard implementation? Again, if you are attending this webinar for CPE credit, you'll have to complete all 3 polling questions, and this is the second of the 3. Going to give about another 10 seconds or so here. Thank you. Great, thank you, everybody.
Okay, so to get into the nuts and bolts of what the standard's about, essentially both finance leases as they're referred to, which these are the previous capital leases, and operating leases will now be recorded on the balance sheet as right-to-use assets is what they'll be referred to as, and lease liabilities. The guidance does retain the difference between an operating and a finance lease, and there's separate accounting for both, which we'll get into shortly. Criteria as far as the finance or the capital leases go does remain largely the same, except for one addition. You'll see the first 4 attributes here are the same as what we had went through before. The only difference is this last item, that the underlying asset is such a specialized nature that it's expected to have no alternative use to the lessor at the end of the lease term. If it meets that or any of the other 4 items, it would meet the criteria of being a capital lease. Otherwise, in the absence of that, it would be classified as an operating lease. With any standard, you're going to have some exceptions, and this one's no different. Leases with terms of 12 months or less, those would be an exception to this rule. So there wouldn't have to be any sort of special accounting for those items. They do consider all renewal options, and the terminology that they use is reasonably certain as being executed as of the initial lease being entered into, and we'll touch on those a bit later. And they really do look at all economic factors of the lease. So the first step here when we're looking at any agreement is to determine if a lease exists. And understanding the definition, determining whether a contract is or contains a lease is a critical step, and it's a bit more extensive than previous cap. Under the previous definition, it was really just an agreement conveying the right to use property, plant, or equipment, whether that be land, depreciable assets, generally for a stated period of time. The new definition, as I've included on this slide, it's a little bit different, and I'll get into why that's important. It's a contract or part of a contract that conveys the right to control the use of an identified property, plant, or equipment, an identified asset for a period of time in exchange for consideration. There's a couple key points here. The contract title does not dictate a lease. It doesn't have to necessarily be called a lease to still meet these criteria and be considered one. It can be explicit or implicit and embedded in any document, so it doesn't have to be standalone. Essentially what you're looking for, though, is that the lessee has control of the asset and they have the power and the benefit of the asset. So just from looking through the standard, what we found is there's a lot more of these agreements that look to be meeting the criteria than what may have previously, and so that's important to keep in mind here. It's really just placing an emphasis on the aspects of control, who has the benefit, the power of that asset over the term. So just be careful when the takeaway here is when analyzing agreements. Make sure you're not just assuming because it's not called a lease that it's not to be considered one. As far as recording the lease goes, finance or capital leases, this is going to be recorded very similarly to what it is right now. So not real huge changes there. I don't want to spend a ton of time on those. Where I want to focus is on the operating lease side. You'll see on the balance sheet now these will be recorded as right-to-use assets with a corresponding lease liability. And then all of that's going to flow through the income statement as a lease expense. And we have a table coming up here shortly that I think will be helpful and kind of illustrate the differences between the two. So you'll see here from a balance sheet perspective, both are going to be essentially the same as far as finance and operating leases. The difference is really going to be on the income statement and cash flow statement side. It's just recorded slightly differently for a financing lease where you're going through amortization expense and interest expense, whereas for operating leases, you've got this single lease expense on a straight line basis. And then from a cash flow perspective, all of the operating leases, those are going to be flowing through the operating section, whereas financing, you've got a component going through financing. So this is a helpful slide to help illustrate what the changes are going to be for most folks. A couple key items of note here. The lease term, when you're looking at analyzing these, it's considered to be the initial non-cancelable term plus any optional periods that have a reasonable chance of being executed as of the lease commencement date. So again, getting back to what I spoke about before, it's reasonably certain as of that date, and then those get accounted for accordingly. From a lessor perspective, that accounting remains largely unchanged. So something to keep in mind there. And then as far as any lease modifications go, those need to be analyzed individually to make sure that it's either a new lease or a modification of an existing one and handled appropriately. A few additional considerations here from a related party standpoint. I think the main takeaway is just make sure that there's written agreements in place. I think in practice, largely we see that those agreements are very informal. There isn't any sort of real written documentation or real terms written down. We would encourage people to address that prior to this being adopted, just to make it easier to bring all these operating leases onto the books at the appropriate values. And quite possibly the biggest impact this is going to have, you'll see, is on debt covenants. And we're going to go through an example of that shortly. So the issue with debt covenants, and this is going to require proactive management right now, is that it's bringing on a large balance of assets and liabilities onto the books. And something to know, we've done a number of presentations over the past couple of years, and not all financial institutions are aware of this, or at least are addressing it as they ought to be. And so this is something that I think folks need to be proactive in prompting discussion with lenders now. And there's a few options that can address this, whether it's changing the covenant entirely or just using what's considered to be frozen GAAP, which is essentially ignoring any of those operating lease assets and liabilities for the purposes of the covenant calculation. So the important thing is just to be having those discussions with your lending institutions now to make sure you're ahead of it. So a quick example, I think, really serves to drive this home for folks. You have an operating lease, 5-year lease, $20,000 payments per month with a 4% interest rate. This next slide here shows the balance sheet after implementation. And so you'll see along the right side here, you've got a debt to equity ratio. Prior to the implementation, the debt to equity was 0.7. Post-implementation, just overnight through the adopting of this standard, it ends up being 1.4. And this is without essentially anything changing. You're just bringing on those assets and liabilities onto the books for those operating leases. So overnight, if you were supposed to have a debt to equity ratio lower than 1, you've just failed that overnight. You can see here in this example that ratio is doubled. So you can see where that could cause some problems with some ratios here. Same thing goes for the current ratio. You'll see a before and after change here. So this is why we're encouraging folks to really get ahead of this and consider it before it comes time to be adopted. Same thing goes with some of the other related coverage ratios. So you're like an interest coverage ratio based on how the income statement accounting goes. So the point is this will have an impact on covenant ratios. And so it's critical that folks are being proactive, reviewing these now and working with lenders early, and not just leaving this for the last minute. A couple closing considerations on the area, on this area before we move on. It's going to have a large impact on essentially any companies with leasing activity, and there's some pretty large costs that we've seen to prepare all this information and to upkeep it, both from a time and personnel standpoint. And it's going to necessitate the preparing of an inventory of leases in order to track all of this. And so it's something you just want to get ahead of and make sure that you've got a good idea of where everything stands prior to adoption. And one other thing I would just say, from a financial statement presentation, there's going to be a lot more disclosure as well. So just make sure that you're collecting as much information as you can as possible and having the discussions with your auditors ahead of time. Now back over to Marcus.
So this will be a fairly quick one. These remaining standards that we're going to be talking about are somewhat less broad and impactful, more targeted, and so we'll be able to get through them fairly quickly. For those who are interested in the responses to the polling questions with respect to revenue recognition, 36% of you are complete with your analysis, 38% in process, and 26% not yet out of the starting gate. So I would encourage you to get rolling, and kudos to the 36%. With respect to leases, 16% are complete, 44% are in process, 40% not yet assessed. Perhaps that reflects the additional time that you've got for leases, but certainly to the extent that you've got significant operating leases, you really probably want to begin that analysis now and understand the implications. We did receive one question regarding RevRec implementation, and the question was that if we don't present comparative financial statements, could you use the retrospective restatement method? Would you need to reissue the prior year statements in that case? So essentially, if you're presenting single year financial statements, all of the contracts that are open would be restated as of the beginning of, let's say, fiscal year 2019. At the beginning of 19, there would be a cumulative effect of change in accounting principle. You would not need to disclose in the footnotes what the financial statement lines would have been under existing GAAP, and no, you would not have to restate previously issued financial statements. The complications come in more when you've got comparative statements and you're not comparing apples to apples. So 2016-01, recognition and measurement of financial assets and liabilities. This was an ongoing, the FASB, the standard setters, have been trying to assess what information might have helped a decade ago with the 2018 crash, what would have made statements more transparent and helped identify risk factors. And it's also, again, a convergence with the international financial reporting standards. The main issue here is that if you've got equity securities, if you've got stocks, for example, and they are currently considered available for sale securities, and therefore the changes in unrealized gains and losses are flowing through other comprehensive income, that treatment is going to change. All of that activity will go through the income statement. It will be going through your P&L. So to the extent that you have available for sale equity securities, you need to be mindful of this. And if it's going to impact covenants based on the different treatment, since it will be included in the operating measure, be aware of that and initiate, similar to leases, any conversations that you may need to have with the bank. You may measure those securities that don't have a readily determinable fair value at cost less impairment, plus or minus any changes resulting from observable price changes in orderly transactions for the identical or similar investment of the same issuer. And essentially, there is an impairment analysis which is qualitative in nature that's similar to that which is performed for goodwill, that would ask you to take a look at the macro factors, the performance of the investee, the market that it's in, overall market conditions, to identify situations where there may be impairment. What's eliminated by this standard is the requirement to disclose the fair value of financial instruments measured at amortized cost, unless you're a public business entity, in which case that requirement continues. And if you're a public business entity, you no longer need to disclose the assumptions that are used for disclosure purposes when you're disclosing fair value of items that are not recorded on the balance sheet at fair value. There are some additional disclosures for public business entities about how you determine those estimates of fair value. Those go away. And finally, you're required to present separately in other comprehensive income the portion of the total change in fair value of a liability resulting from the instrument-specific credit risk. So if you've got liabilities that are recorded at fair value, you may have to bifurcate the nature, the drivers of the change in that fair value. You will have to separately disclose financial assets and financial liabilities by measurement, category, and form. So you've got to take a look at different assets and how they're measured and make sure that they're broken out either on the balance sheet or in the notes. And you should also be thinking about whether or not any valuation allowance is required for deferred tax assets that are related to those available for sale securities. Again, the implementation date is upon us, so calendar year ends 12/31/19 and thereafter. This new standard is applicable. And we're up to our third polling question.
The third question is now live, and this will be related to our next section on LIBOR. If your company has agreements that are currently referencing LIBOR, have steps been taken to start addressing its cessation? Again, this is the final polling question for CPE credit. So if you are attending for CPE credit, you will need to answer this question. We're going to keep it open for just a few more seconds here. All right, thank you, everybody.
All right, so the next area we're going to touch on has to do with the future of LIBOR and the related reference rate reform. Just quickly, LIBOR, the London Interbank Offered Rate, it's a benchmark rate that's based on lending rates that banks charge each other for short-term loans. In 2012, there was an issue that essentially several of the banks that were participating in preparing the information for LIBOR were colluding to manipulate those rates. The reason this is possible, those rates are determined by what each bank reports, and then that's aggregated up to determine what LIBOR is. So by submitting that false information, they were able to profit off of that. And this isn't just an issue with LIBOR, this is really with all interbank rates. There's the possibility for this type of manipulation. So why do we care? Why is this an issue today? One of the byproducts of the investigations that had gone on was that the reporting requirements requiring that the applicable banks submit information for LIBOR, that ends at the end of 2021. So what does that mean? And there's no indication of that being renewed either. Essentially, what that means is at the end of 2021, that LIBOR is essentially expected to be a dead rate at that point in time. There's estimates of, just for US dollar LIBOR, of that it's being referenced in approximately 150 to 200 trillion in contracts. And so if that rate was to go away overnight, you could see the instability that could cause both on a macro level and just with any of you folks that might have agreements referencing LIBOR. So this isn't necessarily a small issue by any stretch. As far as, and this is specific to the US dollar LIBOR replacement efforts, there's efforts going on across the globe, but the Alternative Reference Rates Committee, this was formed by the Federal Reserve Board in 2014, and this is tasked with finding a suitable replacement for the US dollar LIBOR. As far as everything they've been doing over the past few years, I don't want to go into all of that, but a couple important notes here. They've suggested that the secured overnight financing rate take over as a replacement for LIBOR, which is an overnight cash borrowing rate that's collateralized by U.S. securities in a repurchase agreement market. And this is important because this has essentially been accepted by FASB, GASB, and the IRS as a suitable replacement rate. And we'll get into that shortly. The last piece I wanted to touch on has to do with some transition resources that they put together as well. And I've included the link here on the slide. Particularly if you're looking to stay abreast of information here, or if you're looking for some contract language in order to adjust your own contracts for this rate going away, this would be a good place to start. So as far as an accounting standpoint goes, FASB, GASB, and the IRS are all taking steps to try to address this. And essentially, the concern would be that normally with any change in rates that you might have to revisit the accounting for those agreements and adjust accordingly. Essentially what they're looking to do here is make it so that any of these changes associated with reference rate reform don't end up being accounting transactions to where you actually have to change the accounting for it. They just continue to be exactly how it was when you first started it. So good news on a debits to credits front to where you shouldn't have to make massive accounting changes for the adoption of or the change of any of these rates. We do want to, that doesn't mean there's no action items though and things that you shouldn't be focused on right now. So while there's minimal debits and credits, just make sure that it's something that you've got an implementation team together for to assess, because any of the contracts you have referencing LIBOR, those will have to be modified prior to this going away in order to minimize disruption. So make sure you're going through and inventorying all your agreements, reviewing those contracts to see which ones actually have LIBOR reference, and from there determining what's your best approach in terms of transitioning from LIBOR to a replacement rate. And I would just say stay informed. That ARRC website that I had posted, that would be a good place to do so.
Okay, a couple quick questions have come in that I'll try to give a very brief answer to before moving on. One had to do with respect to RevRec. If you have a contract for unlimited perpetual software supplies for a limited time period, is the software revenue supposed to be recognized when shipped one time or to recognize over time? And I would say this is probably the wrong forum to try to give a slam dunk answer to what may be a fairly complex contract, but the key will be to determine the nature of the performance obligation. It may be, given that it's unlimited number of supplies during a specified time period, it may qualify for what's called a stand-ready performance obligation. And there are certain practical expedients that may allow you to recognize the revenue when the amounts become billable. But there's a number of different facets to that analysis that are fairly nuanced, and I think you need to be careful to take your time with that one. The second question was, regarding revenue recognition and financing, are there any changes involving interest expense when a customer gives you material payments, a large sum of cash up front, and you have deferred revenue? So yes, the timing of payments can change the nature of revenue recognition. If you're receiving large upfront payments and the performance obligation extends beyond 1 year, there would be a financing component. And likewise, if you accept payment on the back end, but you begin performance a year in advance of payment, essentially you're either lending to your customer or your customer is lending to you, and therefore there is a financing component of that would be recognized as interest income and expense on the P&L. So there are practical expedients if the performance obligation doesn't go beyond 12 months, but for beyond 12 months, yes, there's a financing component to consider. So very quickly, before we move on to the tax component of our presentation, there are a few standards that impact cash flow presentation, and we'll talk about those briefly here. The first is intended to just reduce diversity in practice with respect to a specific number of cash flow transactions, and they are as follows. So number one, if you've got payments for debt prepayment or debt extinguishment, those are financing activities. So these are all areas where the standard setters believe that there's diversity in practice and they're trying to make it more black and white. If you're settling zero coupon debt instruments, the portion that's attributable to interest is operating activities, and the portion attributable to principal is a cash outflow from financing activity. This one is interesting. If you are in a business combination and there's an earn-out provision or contingent consideration payable to the seller, the classification cash flows depends on the time frame of settlement, and the amount of settlement compared to initial estimates. So cash payments made within 3 months or so of an acquisition should be classified as cash outflows from investing activities, which is where the rest of that transaction's outflows would have been recorded as well. If it's made thereafter, at longer than 3 months, up to the amount of the original liability that you had recorded, that cash outflow is financing. And if you pay in excess of the original liability, it's cash outflow from operating activities. Number 4, settlement of insurance claims depends on the nature of the claim. So if it's property, plant, and equipment that was damaged, that would be investing activities. If it was received for business interruption insurance, for example, that's an operating item. So you look through to how are the cash flows presented for the related items that the insurance is reimbursing you for. Number 5, settlement of corporate-owned life insurance policies should be classified as cash inflows from investing activities. And you're permitted but not required to align the premium payments with those proceeds. Number 6, equity method investments. If you're receiving cash from equity method investments, a portion of that is return on investment, which would be considered operating activities. And to the extent that your cumulative cash payments, cash receipts exceed the change in the value of the equity method investment, you would be deemed to be receiving a return of the investment, the original investment amount, rather than a return on the investment. And returns of the investment would be classified as investing activities. Number 7, beneficial interests in securitization transactions. I don't know how widespread that would be here, but the transferor's beneficial interest obtained should be disclosed as a non-cash transaction. So if we receive an interest in a securitization transaction and actual cash receipts from the transferor's beneficial interest in securitized trade receivables would be shown as cash inflows from investing activities. And finally, the predominance principle, to the extent that you've got a transaction that has multiple elements, some of which appear to be financing, some investing or operating, you really look to the predominant characteristics of the transaction and go with that for presentation purposes. And it is effective now. Last item on cash flows, and is when you've got restricted cash, whether it's for contractual purposes, maybe associated with a debt agreement, you may have cash on your balance sheet along with restricted cash of some sort. Essentially, 2016-18 will simply require that going forward, the cash flow is not rolling forward cash only from the beginning of the period to the end of the period. Rather, you're rolling forward cash and restricted cash on the statement of cash flows. And there would be disclosures required so that you could explain to a reader the various captions on your balance sheet that contain cash and how it is included in that total cash and restricted cash that you're rolling forward. And with that, we'll move on to our update on state taxes.
All right, so state taxes, I'm sure, is the part that everybody's been waiting for here. I'm Chris Buno. I'm a tax manager in the state and local tax group here, and we're going to go through some of these things. I'm going to say, just a reminder to send in any questions you have. I think a lot of the topics here we don't necessarily have enough time to get in depth on and answer all your questions with what I'm going to say. They're more meant to be issue spotting assistance and help you ask the right questions. So here's the agenda real quickly. A Wayfair refresher. That's assuming you've heard of Wayfair before. If not, it'll just be a first-time discussion. Updated economic nexus laws, specifically looking at Connecticut, Massachusetts, and Rhode Island. Some sales tax expansions that happen in those three states. Some state income tax developments in those states. And then the fun topic of Connecticut and Rhode Island pass-through entity taxes, which people enjoy very much. So Wayfair was a case that happened last year. The long and short of it is that businesses used to have a physical presence in states before they had a sales tax collection responsibility. Now that's no longer the case. If you have $100,000 in most states of sales, or in some states they'll look at the transactions. So if you're selling something that doesn't cost a lot and you only sell maybe $10,000 worth, you could still have an obligation to collect sales tax in that state if you have more than 200 transactions. The U.S. Supreme Court has held this constitutional, which just meant that every single state has passed laws on this same concept except for Florida and Missouri. I'm not sure what's holding them up, but I'm sure they'll get to it soon. So looking at particular states that might be relevant to the people listening, Connecticut had a $250,000 threshold. They've since reduced that to $100,000. They're also looking at service revenue, not just sales of property. That's effective July 1. Massachusetts reduced from $500,000 to $100,000, and they removed the transaction threshold altogether. So you're just going to be looking at sales receipts. And Rhode Island remains unchanged at $100,000, but now they're including specified digital products in their analysis. Relevant to this is that our group over here is looking at what does gross receipts mean. We have a lot of manufacturers, wholesalers. They sell a lot of exempt goods. They want to know if this applies to them. It depends on the state. Some states are very broad, some are more narrow. So we're going to look at that and we can provide further guidance on that. Some sales tax expansions that has occurred. Connecticut. Digital goods and pre-written software are taxable at a full rate. It was previously taxed at a 1% discounted computer and data processing rate. There is an exception to this. So if it's purchased by a business for use exclusively in the business, it is still at that 1% rate. But if it's something other than that, you're going to get taxed at the full rate. So it's mostly targeted at individuals. If you're coming out to eat in Connecticut, be prepared to pay a little extra. There's an additional 1% tax on certain meals and drinks. That caught a lot of news attention around here because it was going to impact grocery stores. The state has since walked back from that, and that doesn't apply to grocery stores the same way. And they've also eliminated the exemption for employment-related safety clothing. So if that's a part of your business and you enjoyed that exemption, you will no longer enjoy that as of January 1 of 2020. Massachusetts had a couple of cases that concluded. So now eFax services and remote desktop services are taxable. They also have a proposal for a 5% fee on digital streaming. In Rhode Island, digital goods will be taxed effective 10/1/19. The governor proposed expanding sales tax to additional services, but that failed. That is a common thing that comes up in legislation. 1 year it'll probably go through. State income tax developments, these are things that are related to the Tax Cuts and Jobs Act. States are just kind of passing legislation related to those types of things. Just quickly, there are some pass-through entity tax amendments that happen in Connecticut. I'll discuss that quickly in another slide. There was a salt cap lawsuit that was dismissed. Connecticut being a high tax state for personal income taxes, there was a lawsuit that they joined some other states like New York on that was dismissed. No merit in trying to work that the salt cap passed by the federal government was unconstitutional. There's a different case out there regarding the charitable deduction workaround. This related to that $10,000 salt cap on the personal income tax. And more interesting, there's a payroll tax commission that's established in Connecticut. This is a proposal of a 5% payroll tax on employers in the state of Connecticut. Very interesting. I could talk for a long time on that, but I won't. There's a report due by January 15th, so just stay tuned. We'll probably issue something out of the firm here on that. Massachusetts has some guidance on deemed repatriation and guilty. So if that's relevant to you, there's a DRD of 95% is applicable in Massachusetts. The tax information release is identified there. Also, if you're going through an accounting method change because of difference in federal rules that allows you to change to a cash method, Massachusetts has guidance on that as well. And that pass-through entity tax in Connecticut, Massachusetts passed a directive that said that they will honor that and give you a deduction for that or credit for that in their state on the personal income tax side. Rhode Island has their pass-through entity tax guidance. They've also passed some partnership audit regime reporting. That's related to the centralized audit regime that was passed on the federal government in 2015. So Rhode Island passed something kind of mimicking that and saying you have 180 days if there's a federal change. Connecticut PET. So keep in mind the pass-through entity tax is an entity tax. The intention was to work around the state and local tax $10,000 cap on the personal income tax side of things. So it can be a little bit confusing since it's connected to personal income tax, but it is an entity tax. Some changes here to point out. Guaranteed payments are now included in the standard base and alternative base methods. So, the base has increased, so additional PET coming out of that. There is a credit reduction in the state. So last year in 2018, 93.01% was the credit on your personal income tax return. They've reduced that to 87.5%. That is in true Connecticut fashion. And then if you're an S Corp, it is important to note there's a composite return that a pass-through entity can now file in Connecticut. If you're an S Corp and you do this composite return, which is basically paying personal income taxes for any non-residents in your S Corp, you have to account for that as a distribution. Why that's relevant is that there can only be one class of stock in an S Corp, and so for any of your in-state residents, you would also have to give them a distribution as well, so as to not run afoul of the S Corp rules. And then lastly, we have the Rhode Island PET, which is new this year. It's elective and not mandatory like Connecticut. Individual rate 5.99% is what's applicable to that. But you'll get 100% credit on your personal income tax returns. We're waiting to see if there's any impact for the federal side of things here because it's slightly different than Connecticut, whether or not it would be honored by the federal government. But I don't think it would hurt to do, and that is pretty much everything I have. And just quickly, we have a growing state and local tax group here at Bloom Shapiro. We have representatives here in Connecticut, obviously, Massachusetts, and Rhode Island. So if you have any questions on anything, please feel free to reach out.
Okay, well, thanks everybody for taking some time. Hopefully you found it informative. I would just double back to one of those questions that came in, particularly about the software contract. That one probably has an awful lot of nuances that need to be carefully considered. So certainly happy to help with that, but those contracts can take some time to think through. Any other questions that you have, please feel free to submit them. If we haven't responded during the presentation, we will be in touch. So thank you again, and that wraps it up.
And as a reminder, if you are attending for CPE credit, there will be a survey that goes out tomorrow that you will need to complete in order to get your CPE credit. So thank you for that.